Minda Corporation posted a significant recovery in the second quarter of FY21 as demand picked up quite sharply. In our Ideas for Profit today, we'll discuss what should investors do post these Q2 earnings and see if the valuations really warrant attention. Well, though the numbers definitely got impacted, and that was due to the exclusion of the KTSN subsidiary, that's the German subsidiary which announced insolvency back in June, the numbers from continued operations are still quite encouraging. Minda Corporation, or MCL, has posted a year-on-year growth of 17.5% in net revenues for the reporting quarter. Also, the growth came on the back of, increase in the content per vehicle, and that was due to the transition from BS4 to BS6 emission norms, higher aftermarket sales, and also exports contributing. Now, though its EBITDA margin came back to double digits, it definitely contracted 187 basis points on a year-on-year basis. The contraction was due to the adverse product mix and rise in the raw material prices this time. Now, Minda Corp generates around 60% of the revenue, and that's from the two-wheeler space and the passenger car segments as well. Now, these particular segments are witnessing a significant recovery, and that's after the unlock period started. And this is quite evident from the monthly volumes of the original equipment manufacturers, or OEMs as they are called. For instance, Maruti registered a 19.8% year-on-year growth this time, and Hero Moto also reported a year-on-year growth of 34.6% in their monthly volumes in the month of October 2020. Now, the management is also quite upbeat about these segments and has also indicated that the preference for personal transport would definitely continue to be a key growth driver for the company going forward. Now, the commercial vehicle segment has also started to catch up quite fast with the monthly sales, almost reaching pre-COVID levels as well. And that indicates that the economic activities are picking up, and that's after the lockdown restrictions have been eased and relaxed to quite an extent. Now, Minda Corp is one of the key beneficiaries of BS6 emission norms. This will definitely help the company to raise the content per vehicle, as BS6 compliant vehicles would definitely need higher sensors, wiring harnesses to cut down on emission. Now, in fact, the positive impact was definitely visible in Q2 of FY21 numbers as well. The replacement segment continues to increase its share in the revenue pie and has also grown to 17.5% in Q2 FY21, and that's compared to a 12.9% in a year ago quarter. In fact, the aftermarket also grew 32% year on year in the quarter gone by. Now, we do believe that the demand in this particular segment is expected to be quite robust going forward from here on. Now, on the back of the company's strong distribution network and the wide product portfolio that the company has, what's also encouraging is that Minda Corp also continues to get new orders, and that's despite the challenges, and that also translates into earnings visibility going forward. In Q2, it received orders with an overall lifetime value executed over a project time worth more than 3,000 crore rupees. Now, the company already has raised 83 crore rupees, and that's through a preferential issuance of equity shares to a fund managed by Fee Capital Management LLP. Now, the management has also highlighted that the fund and Fee Capital also have a rich experience within the auto space, and they will support Minda Corp in identifying the value creation opportunities, also performance management going forward from here. They will help in financial planning and also long-term strategy to create a long-term sustainable value. Now, amid a weak demand outlook and the concerns over, the European subsidiary, the stock price of Minda Corp has already corrected 42% from its 52-week high levels, and this has made the valuations really attractive at this point in time. It is currently trading at 11 times FY22 projected earnings, and therefore investors can look to buy this stock with an eye on the long term.